Karnataka is the fourth largest automobile producing state in India, contributing 8.5% to the nation's vehicle production. The state also has the highest number of EV charging stations, boasting an impressive 5,765 public stations. We were the first to introduce an EV policy in 2017 and will soon unveil a clean mobility policy at our upcoming Global Investors Meet. Backed by our progressive policies, world-class infrastructure, and a skilled workforce, Karnataka is paving the way for growth in both traditional and EV sectors. Join us at Invest Karnataka 2025 and be a driving force in the future of automotive and EV innovation.
I shall now state the rationale for the decision in brief. The MPC noted that inflation has declined, supported by favorable outlook on food and continuing transmission of past monetary policy action. It is expected to further moderate in 2025-26, gradually aligning with the target. The MPC also noted that though growth is expected to recover from the low of Q2 of 2024-25 this year, it is much below that of last year. Last year, you are all aware, it was 8.2%. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. And accordingly, the MPC decided to reduce the policy rate, by 25 basis points to 6.25%.
Hello and welcome to Business Today. You're watching Easynomics and we're decoding the aftermath of India's first rate cut in almost 5 years. And joining me to decode the fine print of the latest monetary policy statement that comes days after a consumption-oriented general budget are three senior economists: DK Joshi, the chief economist at CRISIL; Sunil Sinha, one of our regular guests on the show, senior economist himself; and Garima Kapoor, executive vice president and economist at Elara Capital. Welcome to the show. I will go to you first, Mr. Joshi. What seems to have prompted this 25 basis points cut? Is it just the first that each RBI governor seems to do, or is it the first of many?
Well, I think that we'll come to know whether it's the first of many or not. But generally, I think there was an expectation that the central bank will cut rates because inflation was slowly nudging down and growth was slower than expected. I think if you can look at the forecasts for 24-25 have been revised down consistently. So in this environment, the fiscal policy being non-inflationary becomes very important signal for the RBI. So I think if you take all these things together, I think the need for a rate cut was definitely there. But do remember, they have not changed the stance, which essentially means that in neutral stance, they can take care of exigencies if they need to move either way. Because the global environment is so volatile and so unpredictable, I think to say to take it for granted is not possible at this juncture. So you cannot make a one-way bet right now whether the central bank will keep cutting rates. Our assessment is that in the current rate cut cycle, which started today, the central bank will cut rates by something like 75 to 100 basis points, and the timing will depend on the dynamics, both domestic as well as global. And we've seen this playbook in the US monetary policy also. After cutting rates by 100 basis points in 2024, they've suddenly paused. They were supposed to, at that time, it was believed that they'll continue with the rate cuts. But because inflation pressure is very much not gone away in US, and the tariff hikes, if they implement, will push inflation up further, so central bank decided to take a pause. So the point I'm trying to make is that this is a very uncertain environment. The beginning on the rate cut has been made. how much we will see going ahead, whether the next policy will see a rate cut or not, I think that we'll know once we get more information. But our belief is that the rate cut cycle will involve something like 75 to 100 basis point cut.
Sunil, please come in on this and also weigh in on one of the aspects that was being discussed in the run-up to the policy, which is what is happening to our currency and the impact of a rate cut. And I had heard some voices which said that perhaps this would be the time to do a CRR cut rather than a repo rate one.
Well, frankly, if you ask, my own position for today's policy was that perhaps the rate cut would not happen now. And if at all it has to happen, probably it will happen in the month of April when the annual policy would be, presented. But I guess, everything has to be looked into from the perspective of the union budget, which was presented on 1st of February. I guess the government has finally woken up to the fact that the overall growth has really been adversely impacted by the slowing consumption demand. Although this has been, flagged by many for now almost 2-3 years, but somehow government kept on believing that focusing on investment growth and doing other bits would eventually lead to a consumption demand growth as well. But after realizing that it has not happened, they finally bit the bullet. Now, that is the backdrop against which one has to look at today's monetary policy also, because let's not forget that today's monetary policy is the first for this governor. And one important member of Monetary Policy Committee, Mr. Michael Patra, has also moved out. So certainly, the overall composition of the committee has undergone a change. So the overall assessment done by the MPC, in my view, is very, very different from the previous monetary policy committee. So in that context, I believe that RBI perhaps thought that while the government has tried to push the consumption demand, maybe it's time to look at the interest rate cycle, which ultimately is dependent on the inflation. But the projection which they have done for the current quarter as well as for the next 4 quarters shows that inflation is going to be in the vicinity of 4%, which is the target rate. So perhaps all these are the background for today's rate cut.
Garima, in addition to what you might have to say on the rationale as you see it, I just want you to also reflect on the point that post fiscal side stimulus through tax rebates, does this 25 basis points cut constitute a monetary stimulus as well?
Hi. I would not really view this as a monetary stimulus in the sorts, because there has always been a debate over last 6 to 9 months regarding the slowdown and the momentum of growth. In the backdrop of the fact that where the visibility of inflation, especially for the coming quarter, looks to be well below the 5% handle, number one. And number two, we are very clear about the fact that the growth momentum in the economy has moderated. The reasons could be debated. I think this rate cut was well on cards. So I would not look at this as monetary stimulus, but I would probably say it is something that was due and has happened. The signal of this rate cut already started, I think, from the fact that last 15, 20 days, RBI has been extremely pragmatic in terms of providing liquidity, right from the overnight money to including that of the swaps and the OMO announcements. In fact, RBI has been buying bonds in the secondary market outside the auction route as well. And even before the liquidity measures were announced last week, 30,000 crore worth of bonds were already bought in the secondary market. So the backdrop, or I would say the direction of RBI's actions was moving towards a rate cut, number one. Number two, I would say that the fact that RBI decided to allow rupee to reflect its true real effective exchange rate, or rather to reflect the global dynamics, because there has been a greater debate on whether we did not allow rupee to be in sync with the global currencies, especially what was happening in terms of dynamics of RER. I would say the rupee's depreciation is delayed but due. Now, in the backdrop of a fiscal policy announcing about 1 trillion worth additional stimulus, or I should say tax breaks, the consolidation of fiscal policy gives you a respite for RBI. So, if I have to look at these three conditions, it really doesn't sound like a stimulus, but it does sound like an end to a restrictive policy, which was probably followed over last 1.5 year, particularly an end and peaking out of macroprudential tightening. Remember, the growth or pro-growth stance is not coming so much from the rate cut, or is not likely to come from the rate cut, as much as it is going to come from the pragmatism that governor has indicated with regards to certain policy guidelines
Right.
with regards to which was sitting in the draft book. So I would say I'll not really call it as a stimulus, but I would call it probably a response to the conditions that we've entered this cycle into.
Before we go back to Mr. Joshi, I want to do two things. One, request my colleagues to play out another small bite of what the governor had said on interest rates, and then we'll also take a look at the markets to ask a broader question of Mr. Joshi. Let's try and listen into what the governor had to say.
The tremendous uncertainties, that we are facing today, that does not call us, to change our stance. So our stance remains neutral. This restrictive, less restrictive policy is only, for this particular MPC meeting, and not, going forward. This stance continues to be neutral.
DK Joshi, allow me to digress for a moment from the immediate subject of what we have been discussing, and I want to bring in a third element for overall growth in the next year and perhaps beyond. Tax stimulus. I don't know how much of that you believe will feed into growth. Monetary cycle easing. You spoke about that. You mentioned 75 basis points. And likely GST rationalization as well as the third element. If it were to pan out as expected over the next 3 months, the GOM report being accepted in part or full, what does it mean overall for our growth trajectory?
Well, I think the growth, as the first point, the income tax rebate to the middle class will help certainly, because I think it's the urban consumption which was weak, and the rural is doing quite well. And the tax rebate is going to help urbanites more than it helps the rural part of the economy. And this part of the population had not got relief so far. So I think that will lead to some upward movement in consumption. Don't forget, this is not a one-time shot. Every year, I think they'll get that rebate. So it's an ongoing thing, and that is going to be positive for consumption. GST rationalization, I think, as and when it happens, it's not going to catapult India into a different growth trajectory. I think it will be only mildly supportive. So I think the broad issue is that we need to watch out for how the government manages to do the public investments that it has committed, which is at 10% growth over the last year. Do remember that last year they were not able to meet their capex targets. So I think the more focus should be on delivering on those budgetary commitments, which by making the projects more shovel ready, etc., etc. So I think that is what I would be watching. Monetary policy, yes, I think it's mildly supportive of growth. Now, many of the interest rates in the economy are linked to the repo rate, so you will see a impact on the EMIs, I think, and if more rate cuts happen, then that will reflect more. But as we know, I think the interest rates don't impact the economic outlook with immediately. I think there's usually a lag of 3 to 4 quarters, so it will gradually seep into the system. And we need to, I think the biggest risk right now is from the global side. So how the global economy plays out, what kind of tariff actions are taken by US, what is the retaliation to that, and how it spills over to the financial markets. I think all those things also become very important in determining the macro outlook for India, also determining the exchange rate outlook, capital inflow. So there are many moving parts at play right now, I think, which will come together to shape the economy. I think our expectation is that we'll grow at around 6.5% in 25-26.
That does not call us, to change our stance. So our stance remains neutral. This less restrictive policy is only, for this particular MPC meeting, and not, going forward. This stance continues to be neutral.
I shall now state the rationale for the decision in brief. The MPC noted that inflation has declined, supported by favourable outlook on food and continuing transmission of past monetary policy action. It is expected to further moderate in 2025-26, gradually aligning with the target. The MPC also noted that though growth is expected to recover from the low of Q2 of 2024-25 this year, it is much below that of last year. Last year, you are all aware, it was 8.2%. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on.
Let's also reflect on another point that the governor made, and I want to go to Sunil Sinha on this. The comment that the governor made, and I'm trying to read this, Sunil. We will strive to further refine the building blocks of this framework. He is referring to the flexible inflation targeting framework by making advances in the use of new data, improving nowcasting and forecasting of key macroeconomic variables, and developing more robust models. This he was saying in the context of the framework that was introduced in 2016 and reviewed in 2021. What is this hinting towards? Is it just a normal statement, or is there a deeper meaning that we should read into this? Sunil, if you could unmute yourself.
Yeah. Siddharth, as we all know that the inflation targeting framework started in 2016. And since then, inflation targeting has been in operation. But we have seen time and again that RBI's projection about inflation has not been on target. I mean, there have been numerous occasions when RBI's, overall inflation projections has been underestimation, in the sense that the actual inflation has turned out to be much higher. And in fact, there has been even occasions where it remained in excess of 6% for 3 consecutive quarters. So clearly, the overall monetary policy framework, which essentially focused on inflationary targeting, means that the overall inflation projection needs to be much more accurate than what has been till now. And although it is very difficult to predict, because inflation in India is also constrained or guided by unforeseen circumstances a number of times. I mean, say, for example, climate-related issues sometimes become very important in terms of driving inflation. Similarly, the geopolitical situation like Ukraine war, etc. So all these things, and there are many moving parts which are not, predictable. But nevertheless, this whole game of nowcasting and forecasting and basis that making policy is at the core of this whole monetary policy. So somewhere, I guess, what governor is hinting at is that whatever tools, techniques, mechanism they have been applying till date, they would like to revisit that. And also, if possible, some more data points that needs to be looked into. So they would like to look at all of this so that at least the projection made by RBI with respect to inflation turns out to be more accurate than what has been in the past. And in fact, if you look at the today's policy and the reduction in policy rate by 25%, that clearly hints that the inflation over the next 4 quarters or maybe 5 quarters, including the next fiscal year, is going to come down from 4.8% from this fiscal to 4.2% in the next fiscal, which is almost closer to the target. So that may have prompted the RBI to take the 25 basis point cut in today's policy.
Garima, allow me to switch gears unless you want to comment on what we've been discussing so far, because I wanted to come to you on the deferral by a year of the liquidity coverage ratio norms and what was basically said by the governor that does not think that there is sufficient enough time for implementation of these guidelines. How significant, according to you, is this deferral?
See, this deferral, I think, Siddharth, was broadly anticipated by the banking system because the feedback from the banking system once the draft rules were put in place was that it was a bit too severe a measure in the backdrop of a liquidity situation which was already very, very severely tight or crunched. So, an extension of this, including the reassurance that the system would be given adequate time to implement and likely phased implementation will take place, is extremely reassuring. In fact, not just LCR, the two guidelines relating to even your ACL and as well as project finance, which were highlighted by the governor, all these three measures actually are extremely comforting because there was a concern in the system that we may have probably moved or we may be moving towards a situation where we might make the cost of funding extremely stringent or tied in a situation where the economy was already showing a subtle bit of slack in momentum and the private capex was not picking up. So I would really rate this as much more positive than probably today's rate cut, because today's rate cut was already priced and it was expected. The pronouncement of the governor with regards to deferment of implementation of some of these draft rules is, I think, is more pro-growth a measure and much more, I should say, a stronger message than maybe today's measures with regards to the rate cut.
Let's take a look at our broader indices at this point of time, because post a policy announcement of this kind, you would expect a certain kind of response. But it seems, as we try and bring up our indices on the screen, that the Lal Street isn't really sharing this first rate cut in 5 years. You have the Nifty right there on the screen. And if you bring up the rates that we are seeing, it's very clear that the banking system banking stocks down almost 285, the Nifty Bank Index right there on the screen. Mr. Joshi, in terms of the play out, is the market reacting to perhaps not that very confident outlook on inflation from the governor, from the MPC announcement? What seems to be worrying the street, according to you?
Well, I have not analyzed the street behavior, so I don't think I'm in a position to answer that question.
Sunil, can I take that question to you? From a broader economic point of view, do you think, as far as the inflation-related commentary is concerned, what the governor has said provides some sort of reassurance on the trajectory and likely course of prices? Sunil, you'll have to unmute yourself.
I mean, Siddharth, overall, the inflation trajectory, which has been outlined by the MPC, is comforting. But as I was saying earlier, that the inflation trajectory has been, turned out to be very different than projection, not because it's a fault of RBI, but there are still many moving parts. I mean, say, for example, the way the rupee has depreciated. I mean, one comforting factor is that the oil prices have not hardened, but nevertheless, the rupee depreciation would certainly increase the cost of oil import, and that will have implication for inflation in the domestic market. Similarly, I mean, I live in the northern part of India, so here again, I mean, this time the winters have been much warmer than what it has been, and in fact, it is said that January this year is perhaps one of the warmest in the recorded history. And all of these will have implication for agricultural production, although time and again it has been said that the Rabi sowing has been very fine and the Rabi crop is good, and probably we will have a bumper Rabi harvest, which will provide further boost to the rural consumption and so on and so forth. But the fact of the matter is that if the weather remains the warm as it is going to impact the wheat yield as well as the yield of many other Rabi crops. So, I mean, net, when you look at all these issues and try to put it in perspective, along with the global scenario, then overall growth prospect, even though RBI has stated that it will be 6.7% in the next fiscal, I mean, you do not feel very confident about it as if this is attainable. I mean, this year also, the initial estimate was that it will be 7% plus, and then eventually it was brought down to 6.5%. So my own view is that something of the similar kind may happen the next fiscal as well. And if that happens, and somewhere, obviously, markets try to look at the future, and if future doesn't look very assuring, then just 25 basis point cut or maybe, some income tax relief for middle class in the budget itself is not going to move the needle much.
Before I go to Garima, let's take a look at the FMCG index. Consumption has been the focus from the 1st of February. In fact, a day before that, from a macro perspective.
So now you'll have to repeat the question because there was a video of RBI governor that was playing in the background.
Garima, I was asking you that what do you think is the reason for the market reaction? We just played out the FMCG index, which is down almost 658 points now. What is really driving this kind of negative response to this monetary policy announcement?
I think broadly the response is twofold. One is that the markets and some of the traders in the markets were positioned for an anticipation of some liquidity measure. Particularly, there were some who were anticipating a CRR cut. Number two is the change in stance, because there were those who believe that since we are proactively moving towards a monetary easing cycle, it does warrant a change in stance that would give more visibility of the quantum or in terms of the timing of the future rate cuts. RBI's policy, while cutting today, has refrained from making any strong forward-looking guidance, number one. Number two is the markets are probably, and if you notice, especially since you mentioned consumption stocks, barring the first 2 days after the fiscal or the union budget, you have not really seen significant traction in the performance of the consumer stocks for a couple of reasons. One is that the market is awaiting where you would clearly see the consumption boost to come in, because there is a still lack of visibility of how it will play out, number one. And number two is that the backdrop of the cycle also states that we are likely to see these impacts play out only once the banking system liquidity is comfortable, such that the rate cuts or impact of rate cuts is passed on to the retail consumers very quickly.
Okay.
So I think both these backdrops have kind of made the markets a little unhappy about this, but I think it's a short-term reaction. I don't think given the signals that RBI has been giving to us in terms of liquidity provision over last 15 days anywhere indicates that they're not going to provide sufficient liquidity to the system as and when it deserves. So I think we're looking a bit too bearishly to today's policy.
Okay, looking at it too bearishly, two sectors in the green, the auto index there for you, up almost 133 points at this point of time. Realty flat, very clearly a 25 basis points cut, unlikely to cause a massive revival in affordable housing, of which we don't hear much about these days. And at the upper end of the market, not really a big difference. And if you are opting for the new tax regime, there is no home loan factor to consider. I want to come to Mr. Joshi for the last point, and again trying to look forward. Trump 2.0 and the tariff war that he has initiated, and clearly perhaps the US system is also learning lessons from India's past, where announcements are made and then rolled back as far as tariffs are concerned. How significant will be the unwinding of the previous tariff regime and whatever else President Donald Trump of the United States may choose to do as far as the currency is concerned, and any second round impacts on the Indian economy?
Well, I think this is a very interesting question. Now, we really don't know how much Mr. Trump, how far he'll go. So I think it's a speculative in that sense that how much tariff disruption we will see. But in case I think there is very aggressive tariff movement from the US side, there will be a retaliation from the other side. And then a mix of that will not only disrupt the already established supply chains, it will also impact prices in different countries. I mean, the imports into US will become expensive. Monetary policy action will be further delayed, and the country which is China might end up with excess capacity, and they may suffer deflationary pressures, and monetary policy might become easier there. So that's one way to look at it. But I think overall, the way I look at the tariff wars is that there are no winners in this. Overall, there will be a welfare loss. And if I take the case of countries which are not a part of the tariff war, even they will suffer a collateral damage, because if global growth suffers, if supply chains move, I think all that is also going to spill over to countries which really don't participate in that. So I think things to watch out would be how the supply chain shift, if this is a durable tariff disruption that takes place, how the capital flows will be impacted. I think we've already seen a trailer of that. I think the first salvo was fired, and we saw disruptions in capital flows. If US inflation goes up, the yields will go up further. I mean, and then you will again see that's a no-risk investment. I mean, in US bonds, so capital will flow out of emerging markets. So there are many things that are possible here. And the scenario is quite complex, and it's created a huge amount of uncertainty, which also impacts, by the way, among other things, your investment decisions and many other decisions.
Right. Absolutely. Viewers, it's clear that monetary policy and India's trade policy, including responding to what is happening in the United States, will be very closely watched. I have just 30 seconds left on the show. Sunil, a quick comment about the rupee and what kind of trajectory you see panning out in the near term, essentially on account of what is happening in the United States and with regard to flows. I'll have to request you to unmute again, Sunil.
As we have seen in the last few months, I mean, the way rupee has depreciated against dollar, even going ahead, I guess the trade war and the destabilized global economy simply means that there will be a capital flight to safety, means that the chances are that dollar will remain strong against other currencies, which simply means that, the pressure on rupee will continue. And the fact that our forex reserve, which has crossed 700 billion, I think somewhere in September, October, are now down to 630 billion. So RBI's ability to really intervene in the market and really, keep rupee in some kind of a band is also very limited. So overall, I think, we will have to perhaps live with the weakening of rupee even in future. And that will have its own, cost for the economy.
All right, viewers, we've tried to cover multiple points in the aftermath of this 25 basis points rate cut. And my takeaway from the views of our eminent panel of economists here is that as far as India is concerned, quick and fast and nimble responses on multiple fronts will perhaps guide us through the next 3 to 6 months. And beyond that, we'll have to continue to see how America's efforts to reverse 40 years of outsourcing are likely to pan out. That is the single biggest external factor that we all need to watch out for beyond our own domestic factors. DK Joshi, Sunil Sinha and Garima, thank you very much for your time with us today. Viewers, we'll be back with more. Do stay tuned in. Programming continues on the other side after just a very short break.
Karnataka is India's ultimate startup destination with over 14,000 registered startups and 45 unicorns. Bangalore, proudly known as the nation's startup capital, ranks third globally in the number of startups, cementing its place as a powerhouse of innovation. The city also has 144 incubators and accelerators and 1,500 plus VC funds. Karnataka's success is further driven by strong industry-government collaboration, a bold entrepreneurial spirit, and cutting-edge R&D hubs of global giants. As we approach our global investors meet, I eagerly look forward to recognizing and rewarding the startups shortlisted through Venturize, our international startup challenge. Venturize is set to boost startup ecosystem and drive innovation and entrepreneurship across the country. Join us as we accelerate growth and shape the future through Invest Karnataka 25.
Donald Trump and Elon Musk are gunning for US aid.
I think North Carolina, we're going to win North Carolina.
In the latest, the US president has claimed that billions of dollars have been stolen at the agency to